single day I'm gonna make something great. That's my way.
Hi everybody. I am Ginger Wolf and welcome Stripped Finance. This video is for informational and entertainment purposes only. I am a feature entertainer and stripper, not a financial consultant. Please speak to your financial advisor about any financial matters. And with that out of the way, let's get into the video.
What is a money market fund? A money market fund is a kind of mutual fund that invests in highly liquid, near-term instruments. These instruments include cash equivalent securities, and high credit rating, debt-based securities with a short-term maturity, such as U.S. Treasuries. Money market funds are intended to offer investors high liquidity with a very low level of risk. Money market funds are also called money market mutual funds. While they sound similar in name, a money market fund is not the same as a money market account, MMA. A money market fund is an investment that is sponsored by an investment fund company. Therefore, it carries no guarantee of principal. A money market account is a type of interest-earning savings account. Money market accounts are offered by financial institutions. They are insured by the Federal Deposit Insurance Corporation, FDIC, and they typically have limited transaction privileges. How a money market fund works. Money market funds work like a typical mutual fund. They issue redeemable units or shares to investors, and they are mandated to follow the guidelines drafted by financial regulators, for example, those set by the U.S. Securities and Exchange Commission. A money market fund may invest in the following types of debt-based financial instruments. Bankers' acceptances, be a short-term debt guaranteed by a commercial bank. Certificates of deposit, CDs, bank-issued savings certificate with short-term maturity. Commercial paper, unsecured short-term corporate debt. Repurchase agreements, repo, short-term government securities. U.S. Treasuries, short-term government debt issues. Types of money market funds. Money market funds are classified into various types depending upon the class of invested assets, the maturity period, and other attributes. Prime money fund. A prime money fund invests in floating rate debt and commercial paper of non-treasury assets, like those issued by corporations, U.S. government agencies, and government-sponsored enterprises, GSEs. Government money fund. A government money fund invests at least 99.5% of its total assets in cash, government securities, and repurchase agreements that are fully collateralized by cash or government securities. Treasury fund. A treasury fund invests in standard U.S. Treasury issued debt securities, such as treasury bills, treasury bonds, and treasury notes. Tax-exempt money fund. A tax-exempt money fund offers earnings that are free from U.S. federal income tax. Depending on the exact securities it invests in, a tax-exempt money fund may also have an exemption from state income taxes. Municipal bonds and other debt securities primarily constitute such types of money market funds. Some money market funds are targeted to attract institutional money with a high minimum investment amount, oftentimes $1 million. Still, other money market funds are retail money funds and are accessible to individual investors as a result of their small minimums. Special considerations. The net asset value, NAV, standard. All the features of a standard mutual fund apply to a money market fund, with one key difference. A money market fund aims to maintain a net asset value, NAV, of $1 per share. Any excess earnings that get generated through interest on the portfolio holdings are distributed to the investors in the form of dividend payments. Investors can purchase or redeem shares of money market funds through investment fund companies, brokerage firms, and banks. One of the primary reasons for the popularity of money market funds is their maintenance of the $1 NAV. This requirement forces the fund managers to make regular payments to investors, providing a regular flow of income for them. It also allows easy calculations and tracking of the net gains the fund generates. Breaking the buck. Occasionally, a money market fund may fall below the $1 NAV. This creates a condition that is sometimes referred to with the colloquial term breaking the buck. When this occurs, it may be attributed to temporary price fluctuations in the markets. However, If it persists, the condition may trigger a moment when the investment of the money market fund fails to exceed its operating expenses or investment losses. For example, if the fund used excess leverage in purchasing instruments, or overall rates dropped to very low levels nearing zero, and broke the buck, then one of these scenarios could lead to a condition where the fund cannot meet redemption requests. If this happens, regulators may force the fund's liquidation. However, instances of breaking the buck are rare. In 1994, the first instance of breaking the buck occurred. The Community Bankers U.S. Government Money Market Fund was liquidated at 96 cents per share. In 2008, following the bankruptcy of Lehman Brothers, the Venerable Reserve Primary Fund also broke the buck. The fund held millions of the Lehman Brothers debt obligations, and panicked redemptions by its investors caused its NAV to fall to 97 cents per share. The pullout of money caused the Reserve Primary Fund to liquidate. This event triggered mayhem throughout the money markets. To prevent this from happening again, in 2010, in the aftermath of the 2008 financial crisis, the SEC issued new rules to better manage money market funds. These rules were intended to provide more stability and resilience by placing tighter restrictions on portfolio holdings and introducing provisions for imposing liquidity fees and suspending redemptions. Regulation of money market funds. In the U.S., money market funds are under the purview of the SEC. This regulatory body defines the necessary guidelines for the characteristics, maturity, and variety of allowable investments in a money market fund. Under the provisions, a money fund mainly invests in the top-rated debt instruments, and they should have a maturity period under 13 months. The money market fund portfolio is required to maintain a weighted average maturity, WAM, period of 60 days or less. This WAM requirement means that the average maturity period of all the invested instruments, taken in proportion to their weights in the fund portfolio, should not be more than 60 days. This maturity limitation is done to ensure that only highly liquid instruments qualify for investments, and the investor's money is not locked into long maturity instruments that can mar the liquidity. A money market fund is not allowed to invest more than 5% in any one issuer. Advantages and disadvantages of money market funds. Money market funds compete against similar investment options, such as bank money market accounts, ultra-short bond funds, and enhanced cash funds. These investment options may invest in a wider variety of assets, as well as aim for higher returns. The primary purpose of a money market fund is to provide investors a safe avenue for investing in secure and highly liquid, cash-equivalent, debt-based assets using smaller investment amounts. In the realm of mutual fund-like investments, money market funds are characterized as a low-risk, low-return investment. Many investors prefer to park substantial amounts of cash in such funds for the short term. However, money market funds are not suitable for long-term investment goals, like retirement planning. This is because they don't offer much capital appreciation. Money market funds appear attractive to investors as they come with no loads, no entry charges or exit charges. Many funds also provide investors with tax-advantaged gains by investing in municipal securities that are tax-exempt at the federal tax level, and in some instances at the state level, too. Pros: very low risk. Highly liquid. Better returns than bank accounts. Cons: not FDIC insured. No capital appreciation. Sensitive to interest rate fluctuations, monetary policy. It's important to keep in mind that money market funds are not covered by the FDIC's Federal Deposit Insurance, while money market deposit accounts, online savings accounts, and certificates of deposit, are covered by this type of insurance. Like other investment securities, money market funds are regulated under the Investment Company Act of 1940. An active investor who has time and knowledge to hunt around for the best possible short-term debt instruments, offering the best possible interest rates at their preferred levels of risk, may prefer investing on their own in the various available instruments. On the other hand, a less savvy investor may prefer taking the money market fund route by delegating the money management task to the fund operators. Fund shareholders can typically withdraw their money at any time, but they may have a limit on the number of times they can withdraw within a certain period. I am Ginger Wolf. And this has been today's episode of Stripped Finance. I hope you have found this video informative. Remember to discuss any financial decisions with your own personal financial advisor. Please like, comment, share, and subscribe so you don't miss out on any of my future uploads. I will see you all again tomorrow.
Hello, I am Ginger Wolf, and I am sacrificing your bad decisions to the financial fire. So don't forget to like, comment, share, and subscribe. I'll see you next time. Bye!